Hello, this is Corner Invest. Today I'll be talking about the stock market itself recently. So as you can see over here, the S&P 500 is down around 6% from its highs. The QQQ is also down around 10% from its highs. So why exactly is the market selling off? There are three main reasons for this. The first reason is simply just seasonality. So as you can see over here, the stock market is normally quite weak in February. It's normally not so good of a month, and that's why we're seeing like a sell-off now in this year's market. The next reason why the market is selling off is because of this Atlanta GDP number, which came out around 2 days ago. So the Atlanta GDP number is forecasting that we'll have a negative GDP growth in Q1 of 2025. So make that another quarter, meaning to say if Q2 is negative as well, then we'll be in a recession already. So why exactly is this Atlanta GDP number negative? Is because of Trump tariffs. So on the one hand, you have Trump tariffs causing inflation, and then on the other hand, you have Trump tariffs causing sort of like a recession, and that is leading to stagflationary fears. And the third reason why the market is selling off is simply because of tariffs. So Trump has been placing tariffs on all the different countries. You have tariffs on Canada, Mexico, and China, and that is leading to sort of like a tit for tat, meaning to say if Trump imposes a tariffs, then the other countries will impose the tariffs back on Trump and the American people, and that is causing the market to freak out. So if we look back at 2018, there were two instances where Trump imposed tariffs. There was one over here and then one over here as well. There was a 12% drawdown, as you can see, and then there was a 20% drawdown as well. So we're currently now at around a 6% drawdown. So be prepared for a lot more volatility ahead. I could see the market dropping even more despite this current pullback. So be prepared to add on a dip. Be prepared to buy when the prices are a lot lower than current. Adding on to this, we have an overvalued market as well. So as you can see, the market is currently trading at a 29 PE. That is extremely high in terms of historical averages, and normally when the market is overvalued, they will need a catalyst for the markets to come down. And currently the catalyst is tariffs. So is it time for you to sell all your stocks with this market being so overvalued? So with stock valuations this high, is it time for you to sort of like get out of the markets and go into 100% cash now? So there's a famous investor, his name is called Howard Marks. He was the one that timed the 2000 crisis as well as the 2008 crisis. And he's also saying that you shouldn't be timing the market because more people lose money trying to time the market than just riding it through. So more often than not, if you just ride through the entire wave, you will end up in a better situation as compared to someone who is waiting and waiting for a dip. So as you can see over here, let's watch this one.
He would agree that U.S. stock valuations, for example, are on the high side relative to history. That would tell me to be a little less aggressive than usual, a little more defensive, but not necessarily to get out. You know, getting out is really a big step. Most of the time, in my 55 years in this business, it's been a mistake. Either you get out and it goes up, or you get out and it goes down, and you forget to get back in and it goes up without you. So, you know, it's just a matter of calibrating, in my opinion, your behavior between aggressiveness and defensiveness. When things are a little high as they are, a little more defensive than usual. But this notion of risk on, risk off, in or out, buy or sell, that's too black and white. It's not fitting for the world we live in.
Yep. So like what he said, it's better for you to buy a lot more when it's cheaper and then buy on the way up as well. So try not to sell. Selling is always, trying to time the market is always the bad thing to do lah. So what you can do instead is to buy in tranches. So buy on the way up and then buy even more on the way down so that you will catch the uptrend as well when the markets recover. With that being said, are there any good opportunities in the market right now? So a company that I'm looking at right now is Amazon. Amazon is down around 17% from its highs, and it is basically coming down in the markets as well, just in a greater magnitude. So for me, Amazon is an amazing business, it's an amazing moat, and yeah, just look at Finviz over here. So Finviz is projecting around 20% EPS growth over the next 5 years for Amazon. So if I were to key that into an EPS calculator, giving Amazon a 15% growth instead of a 20% growth, that will give Amazon now around a 10% CAGR for the next 5 years. So I think Amazon now is presenting a decent opportunity in terms of the valuation. If they can grow a lot more than 15%, so let's say if they grow 20% like what Finviz said, then this could give Amazon a 15% CAGR, which is a double in 5 years. But for me, I don't like putting it at around a 20%. 20% is a bit too high. For me, my threshold is around 15%. And that's why I'm giving Amazon this 15% growth rate over the next 5 years. So let's talk about Amazon's business now. So Amazon has a few businesses running for it. It has its AWS business, which is the most important part of Amazon's business. You have your retail businesses, your third-party seller businesses, and then your subscription business as well. So for Amazon, the problem with its business is AWS is functioning very well. The operating margins are extremely high, but everything else apart from AWS is almost like it's losing money already. So as you can see over here, in 2023, everything else apart from AWS had an operating margin of 2%. That is terrible for any business. In 2024, the operating margin went up to around 5.4%. That's a double in a year. So I do expect Amazon to continue expanding its margins throughout the next few years. And Andy Jassy, the current CEO, is also a lot more focused on profitability rather than growth compared to Jeff Bezos back in the day. So Jeff Bezos, in the past, he used to prioritize a lot more on growth, meaning to say he will sacrifice profitability now for growth in the future. But Andy Jassy, the current CEO, is a lot more pragmatic. He wants Amazon to increase profitability as well as continue to grow. So let's talk a bit about Amazon's AWS business. So Amazon holds the biggest cloud provider in the globe. Their cloud service are tied to every operation that uses it. So this over here is the 10K of Netflix, and Netflix basically said that if AWS closed down, then the entire business will be hurt. And yeah, Netflix is a competitor to Amazon in terms of the Prime service, and yet they are so tied to AWS. That just shows how important AWS is to every business over here. So their retail business is currently a zero gain game, but I expect that to change. So as you can see over here, I basically estimated their margins for all their different business, and their online stores and their retail advertising, retail businesses and all that have extremely low margins. So margins of around 1%. And if you were to compare that to your other businesses that does retail as well, like Alibaba, your Mercado Libre, their margins are a lot higher than Amazon. So I do expect Amazon to increase their margins over time. It will be a story of margin expansion for Amazon. Next stock that I'm looking at as well is Microsoft. So Microsoft is one of the most predictable, one of the most high quality businesses out there, and it's basically flat for 1.5 years already. So that's not to say the stock is undervalued. So let's take a look at the valuation over here. So Microsoft, if I were to give it a 26 PE, it will give around a 10.6% CAGR at current prices. At a 28 PE, it's around 12% CAGR, and a 30 PE is around a 13% CAGR. So in the 2022 stock market crash in the tech sector, Microsoft had around the lowest PE of around 25 times. So I do expect that 26 times will be sort of like the worst case for Microsoft in terms of valuation. Given the predictability of this business, I think 26 PE is very reasonable for Microsoft. So there are a few businesses from Microsoft. So Microsoft has their productivity business where they sell all the Microsoft 365 and all that, Microsoft Words, Microsoft Office, and all those business. And then you have your personal computing business, which is this Windows, Xbox, gaming portion over here, which is steadily growing as well. And then there is another portion as well of Microsoft, which is their Azure business, which is their cloud providing business. So the good thing about Microsoft is they are able to basically sort of combine everything into one big bundle and then sell them to their consumers. So you have Azure, then Azure will normally be tied to all the Microsoft 365 services, and then they combine everything and sell it as a best package to all the different businesses out there. So over here, Microsoft is one of the most entrenched software businesses out there in terms of cloud and its business productivity suite. The ability to provide customers with the best bundle deal by incorporating everything together as one package and selling them together is what stands out for Microsoft. So Microsoft doesn't sell the best product out there, it sells the best package deal. So Microsoft is one of the highest quality businesses out there, one of the most predictable one as well. Azure is not slowing down, especially with so much need for cloud services, and the other software businesses are steadily growing at around 10% as well. So capex could lead to massive depreciation and amortization if it doesn't pay off. But I do believe that all three cloud CEOs are not dumb. They are just spending it because they see the real ROI in it. So you have Sundar Pichai, you have Satya, and then you have Jassy as well. All three of them are saying that AI is one of the biggest plays out there right now, and that's why they're spending so much money on AI. And I do believe that all these three CEOs are not idiots, unless all three of them are idiots, then we could see a massive correction in Microsoft, Google, and Amazon. But I do believe that they are seeing the true value in AI, and currently their ROIC is in the high 20% for Microsoft as well as Google, and improving as well for Amazon is they increase their productivity and their efficiency in terms of the business performance. So if all these businesses can spend a lot of capex and achieve a very high ROIC, that means that their investments are paying off. And I do believe that all these businesses, they will receive a tangible ROI in the future in terms of the AI capex spend.